Well, it is Saturday afternoon, and it will be a short one today, but there is news out there that is worth reporting. So let me get right into it. First of all, this is from Tesla fan MTL. I refer to him all the time, and he says that China's EV market, this is a cat, China's EV market is bouncing back. Recall that on April 27, China's Ministry of Commerce and Ministry of Finance announced that if you trade in a gas car, you can get a subsidy of up to $1,380 towards the purchase of an NEV. I think this plus general economic improvement is having an effect. And then I don't know if I would agree with general economic improvement in China, but maybe less disimprovement. I haven't looked recently, so I can't really say. And then attached to that would be from Sino_market. He says that NIO delivered 20,544 new vehicles in May. That's pretty good for NIO, marking a year-on-year increase of 233% and a month-on-month rise of 31.5%, achieving a historic high for them. In the first 5 months of the year, NIO has now delivered 66,000 new vehicles, which is a 51% year-on-year increase. Boy, I'd sure like to see Elon Musk and Tesla with a 51% year-on-year increase in China. That would make my heart sing, even if it just started with this month. And we could just count up till now as being, who cares? And now from now on, starting in June, for the rest of the year, 50% year over year over last year. That'd be great. Well, Bradford Ferguson, my regular, of course, on Thursday night on this show, he says, here's an interesting idea. If miles per critical disengagement goes from 300 now to 15,000 miles over the next two versions, so that would be a 10 times in it. Well, I don't know, there'd be a 10 times in it. I think his thinking is a 7 times and a 7 times, roughly, but could be more than that. But 15,000 miles a year, it will take a year for the normal driver to encounter a critical disengagement situation. Now, he brought this up on Thursday night. If you are watching, you know that. But he says, in my opinion, it would still be hard to stay truly vigilant in this situation. So if you don't have any critical interruptions, you're going to go to sleep. You're going to start not paying attention. You're going to have trouble keeping your eyes on the road. So it caused me, Randy, to wonder out loud, are we going to have two levels of FSD complete? Might we have an FSD complete at this level where it's one safety interruption every 15,000 miles and maybe only one interruption of any kind every 5,000 miles or something like that, to where it's like, okay, it's good enough, just go ahead and use it. And these safety interruptions, even those probably are not all going to be that big a deal. They'll be overcome. The car might be in trouble for a second, but then correct itself. So maybe we'll be talking about one accident every, 10 million miles at that point, when it's on full self-driving and nobody's doing anything to correct it. Anyway, there might be one level where that's good enough for the consumer to start using it without any kind of hands-on. But then we might need just even better than that would be for a robotaxi. Not sure. We'll have to see what happens on that. All right, that's just a thought, just a wild hair. From the Kobesi letter, he says today, in Q2 of 2024. Oh, this is changing subjects now to the. We do have one more story about Tesla first, so let me go over that first. Cathie Wood predicted that the market. This is from CB_Doge. He says Cathie Wood has predicted that the market for humanoid robots will grow to 1 trillion by 2030. And Tesla is well positioned to cash in. So let's just say that if she's right and it's 1 trillion and Tesla only gets 20% of it, that would be 200 billion. That would be all right. We could all live with that, right? I suspect it will be more than that, but it would be all right. Okay, and then, and by the way, I did do a very good video earlier today, which you should very definitely go take a look at. I don't know, is everybody taking a vacation this week? I think I remember from last year that the week after Memorial Day, my numbers just really didn't do well. And so my numbers today in particular have been very soft. So maybe that's because you guys are on vacation. Maybe it's because my titles, maybe I've forgotten how to do good titles and good thumbnails. I don't know. But if you missed that particular video earlier today about what's happening with the robotics, a lot of good stuff from a trade show that was just held last week. Good stuff from a panel that had top names on it. And I think it's valuable, and I'll give you a card on that later on. Okay, so and then you could like and subscribe and hit notify, all those normal things too, because tomorrow morning I'm going to give you an update. Maybe only 12 people will see it, but I'm going to give you an update on what I think is going to happen with 24, 25, and 26 in terms of the profits of Tesla and how that might affect the stock. And this will be sans robots. So this is only for the basic cars, trucks, Cybertruck, energy, and the services sectors. Nothing to do with bots. That's what I'll be predicting. All right. And this is a prediction based on the fact that we're getting almost no helpful information from Elon. So it's going to be an interesting story. So anyway, that's why you want to hit notify. And of course, love to have more folks joining up on Patreon. Thank you for I think we've had 4 or 5 people in the last 4 or 5 days. So that's pretty good. Let's keep that up. Let's keep that going. All right. So then Corbasi says, in quarter 2 of 2024, so far, stock buybacks by S&P 500 companies are now at $333 billion. That's in 2 months, probably less than 2 months. The highest since quarter 2 of 2022. This is the 4th largest quarterly stock buyback level over the last 7 years, and it's got a week to go. A month to go. Additionally, completed buybacks were up 16% year over year in quarter 1, 2024. He suggests that this year buybacks are expected to reach a record 1.15 trillion. As we pointed out earlier this year, stock buybacks continue to be a major driver of higher equity prices. He says, don't underestimate the power of stock buybacks. Well, what I would take from this is I would put it in combination with the information that we've been seeing elsewhere, is that companies are not going public. Yeah, we have the lowest number of public companies, I guess, in history. Maybe I don't know, last 100 years, 200 years, I'm not sure, but very few companies going public, lots of companies going private. And so why? Okay, and Elon Musk has spoken to this. He has shown you the way. He has 7 companies now, 8 companies. One of them is public, and he says, I don't want to take these other companies public. No way. It's way too much trouble, way too much bother, and not enough benefit from doing it. So here you go the opposite way, where companies are buying back their stock, which is helping the stock market for sure. It's going to make all those stocks more valuable if there's less outstanding stock. And at the same time, if people are not going public, well, 2 things are happening. Number one, there's a lot of private companies like Elon Musk's companies. They all have investors, but they're private investors. So overall, does that mean there's more money in the market? I'm not sure. Maybe if there's a lot of private money, maybe it hasn't changed anything in terms of what percentage of the overall investment dollars, what percentage of those dollars are in equities versus other places. All right, this is from Fortune magazine, great article. The Federal Reserve has talked financial markets into creating an easier environment, which paradoxically makes lowering rates a more difficult task for the central bank, according to a top economist. The Bloomberg U.S. Financial Conditions Index, which we've talked about last month and the month before, that financial conditions index indicates that the availability and cost of credit across money, bond, and equity markets are significantly more favorable right now than when the Fed began raising rates in March of 2022. This is according to Apollo chief economist Torsten Slok. Well, this is due to the central bank's pivot in November when Chairman Jerome Powell signaled that inflation was cooling enough to halt rate hikes and start thinking about when rate cuts could begin. Well, Wall Street interpreted those comments incorrectly, as it turns out, to mean easing would be imminent. And then as many as 6 cuts would happen in 2024, sparking a massive stock market rally and also a lowering of the bond costs as well. In a blog post on Wednesday, Slok estimated that the S&P 500 stock index was adding $9 trillion in market cap since then and compared it to the $19 trillion in consumer spending last year. Think about that. He goes on to say, in other words, in a few months, the household sector has experienced a windfall gain corresponding to 50% of last year's consumer spending, he wrote. So your portfolio went up 50% as much as you're earning, as how much you earned in the last 6 months or whatever he said. Meanwhile, the federal government has been spending trillions of dollars on infrastructure, green energy initiatives, and semiconductor production capacity. As a result, the economy has remained strong as this fiscal stimulus continues to fuel growth, while earlier financial conditions offset Fed rate hikes, Slock noted. In fact, the economy was so strong earlier this year that inflation readings came in above forecast and showed signs of reaccelerating. That forced Powell to warn that rates could stay high for as long as needed because inflation appeared to be taking longer than anticipated to reach the 2% target. Still, he later acknowledged that further rate increases were unlikely and reaffirmed that the Fed's next move was probably going to be lower. And that's precisely the mistake Powell is still making in Slock's view. Looking ahead with the stock market hitting fresh all-time highs and fiscal policy still supportive, the expectation in markets should be that the economy will continue to accelerate over the coming quarters, he wrote. You can call this the Fed cut reflexivity paradox. The more the Fed insists that the next move in interest rates is a cut, the more financial conditions will ease, making it more difficult for the Fed to cut. Yeah, in the meantime, I don't necessarily agree that the economy is going straight up. As you know, I'm still 30-70 that the economy is either already in a recession or going into one. Well, to be sure, GDP growth slowed in the first quarter from the first quarter and was revised down to an annualized rate of 1.3 from a prior month reading of 1.6. The latest report also showed that fiscal stimulus was having a smaller effect. Yes, that's what's happening. But consumer spending on services remains strong, and more recent data on jobless claims showed the labor market continues to hold up. Well, we'll find out more about that on this Friday. Meanwhile, minutes from the Fed's last policy meeting reveal that the economy's resilience in the face of rates, listen to this now, in the face of these rates at 23-year highs, has prompted some officials to wonder whether all their tightening was exerting enough pressure on growth. High interest rates may be having smaller effects than in the past, the minutes said. Yeah, I saw that. It's been reported elsewhere, but it's worth repeating. All right, that's all I got for you today. So remember, go back. If you've got a minute, go back and look at that report from that humanoid robot conference. Well, it was actually it was all about automation, but there was a panel on humanoid robots, and the panel was stacked, as the guy says, as the author said. And it had super people on the panel and really good information in terms of the future of humanoid robots. I, again, recommend there is the card right there to go check that out. So leaving you on Saturday night and going on to Sunday morning when you too can find out what I think, for what it's worth, about where things are going to happen with Tesla over the next 2.5 years. It's been great talking to you.